Welcome back, everybody. Today, we're going to be diving deep into Berkshire Hathaway. And we've got some great sources for this one. Looks like you've given us Warren Buffett's 2014 letter to shareholders and also some reflections from his partner, Charlie Munger. So obviously you're interested in this topic of long-term success and what makes a business truly valuable. So I think we're going to have some really interesting stuff to unpack here.
Yeah, you know what I always find so compelling about these letters is just how much they reveal, not just about, the financial performance of the company, but almost like you're getting this peek behind the curtain into how Buffett and Munger think, their investment philosophy, their management style, even their views on human nature and decision making.
Yeah, it's like a masterclass in business and investing all in one. Yeah. So right out of the gate here, Buffett gives us this headline number. Berkshire's per-share book value has grown at a compounded annual rate of 19.4% over the past 50 years. That's a crazy number, especially when you compare it to the S&P 500.
Yeah, absolutely. The S&P only averaged about 9.8% over that same period. But I think the real story here is what's driving that growth. It's not about, chasing the latest trends or making these flashy bets. Berkshire's performance is really a testament to their focus on intrinsic business value.
Okay, so then what is intrinsic business value? How's that different from just looking at a company's stock price?
Right. Well, think of it this way. The stock price is just what the market thinks a company is worth at any given moment. It's driven by, all these things, sentiment speculation. Intrinsic business value, on the other hand, is a much deeper assessment. It's taking into account, the company's earnings power, its assets, its management team, its competitive advantages. So it's really a measure of the true economic worth of the business.
So it's like looking under the hood, not just admiring the paint job. And Berkshire's all about those companies with solid engines, not just shiny exteriors.
Exactly. They're not looking for these quick flips or short-term gains. They're seeking out those businesses that can generate consistent profits and compound their value over time.
Well, and speaking of consistent profits, 2014 was a particularly strong year for Berkshire. And it was fueled by what Buffett calls the Powerhouse Five: Berkshire Hathaway Energy, BNSF, IMC, Lubrizol, and Marmon. Together, these non-insurance businesses earned a record $12.4 billion pre-tax.
And it's remarkable how they've built this collection of these truly powerhouse companies. But what's even more impressive is that they've done it without, really diluting the value of Berkshire shares. 4 of these 5 businesses were acquired in just the past decade. And the impact on, existing shareholders has been minimal.
So they're not just buying any company that comes along. They're being very strategic and disciplined about their acquisitions.
Oh, yeah, absolutely. And it's not just about the mega deals either. Buffett and Munger are also huge fans of what they call bolt-on acquisitions. These are the smaller deals, often in the same industry as an existing Berkshire company, that allow them to just, kind of strengthen their market position, enhance their competitive advantage even further.
So it's like adding a turbocharger to an already powerful engine.
Exactly.
Making the whole system even more efficient. But we can't talk about Berkshire without talking about the engine that's been driving their growth since day one: insurance.
Oh, absolutely. Insurance has been a cornerstone of their success. And it all started with this, surprisingly simple deal back in 1967.
Yeah, this one sounds like something out of a movie.
It really does. Buffett acquired National Indemnity for a mere $8.6 million. And get this, neither company had ever had a formal audit. And Buffett didn't even ask for one. He just trusted Jack Ringwalt, the seller, and kind of went with his gut.
A lot of trust for an $8.6 million deal. But I guess when you've got Buffett's intuition, maybe you can afford to take those kinds of risks. But how does a relatively small insurance company turn into the behemoth that Berkshire Hathaway is today?
Well, that's where the magic of float comes in. So think about it. Insurance companies collect premiums up front, but they don't have to pay out claims until sometime later. This creates this pool of money called the float that they can invest for their own benefit.
So they're basically getting paid to hold and invest other people's money.
Well, it's a little more nuanced than that. But that is the basic concept. And Berkshire has mastered the art of using that float to generate substantial investment income. They've actually grown it from $41 billion to $84 billion in just the past 12 years.
That is an insane amount of money. But doesn't that strategy depend on their ability to accurately assess risk and avoid big insurance losses?
Oh, you're 100% right. And that's another key to their success. They're incredibly disciplined and conservative in their underwriting practices. They would rather walk away from a deal than underwrite a policy that doesn't meet their really strict criteria.
So even in a world of increasing uncertainty and black swan events, They prioritize financial strength and stability above all else.
Absolutely. It's like they're building this financial fortress brick by brick.
Right. And you can't build a fortress without skilled architects and builders. So who are the people behind these massive insurance operations at Berkshire?
Oh, they're a huge part of the story. And Buffett is very clear about that in the letter. He says, the success of these insurance businesses isn't just because of the nature of the industry itself. In fact, he points out how incredibly competitive and frequently unprofitable the insurance industry can be.
Interesting. So it's not enough to just be in the right business. You got to be the best at it.
Exactly. And that's why he highlights the exceptional managers that are leading these companies. You've got Ajit Jain, who runs Berkshire Hathaway Reinsurance Group. He's known for taking on these really complex, hard-to-place risks that other insurers won't touch. Then there's Tad Montross at General Re. He's recognized for his disciplined underwriting and their very profitable international life reinsurance business. And of course, we can't forget Tony Nicely, the longtime CEO of Geico, who's been with the company since he was just 18 years old.
Geico, the one with the gecko.
That's the one. But more importantly, Geico's success under Nicely really illustrates this key principle that runs through all of Berkshire's businesses, the power of a durable competitive advantage.
So it's not just about being good. It's about having that sustainable edge that allows you to outperform the competition over the long haul. But Geico wasn't always the giant it is today.
No, not at all. Buffett actually first encountered Geico back in 1951. He was drawn to their low-cost business model, but it was Nicely who really took that model and scaled it. He grew their market share from a mere 2.5% in 1995 to an impressive 10.8% by 2014.
That's incredible growth. And it all comes back to that durable competitive advantage, something we see over and over again in Berkshire's businesses. Which brings us to two more giants in their portfolio, BNSF and Berkshire Hathaway Energy. I mean, these companies are almost too big to even comprehend.
They are, but that's what makes them so fascinating. These aren't just businesses. They're vital arteries in the U.S. economy.
Yeah, BNSF alone carries about 15% of all intercity freight in the U.S. They move more ton miles of goods than anyone else. They're literally powering the movement of products across the country.
And Berkshire Hathaway Energy, while energy might not sound as exciting as railroads, they've been a quiet leader in renewable energy. They're powering homes and businesses while investing in a more sustainable future.
Okay, so we've got these two massive businesses essential to the U.S. economy. But even giants face challenges, right? What were some of the things that BNSF was up against in 2014?
You're right. Even with their size and their impressive track record, they did run into some service issues in 2014. They actually ended up losing a little bit of market share.
Wow, that's surprising. What happened? Did they get complacent or something?
No, not at all. They actually invested a lot of money in recent years, but it seems like the demand just outstripped their capacity. Even with really careful planning, you can't always predict those sudden surges in demand.
What's the plan? Are they just going to accept this setback?
Oh, no way. Berkshire is known for taking that long-term view, and they're committed to fixing these issues. They've actually allocated a huge $6 billion for 2015 to improve BNSF's operations. That's 26% of their estimated revenue. So a huge commitment to regaining their competitive edge. And, this commitment to long-term thinking isn't just limited to their operational decisions. It's really baked into Buffett's investment philosophy. And is something that's evolved over time, influenced a lot by his partnership with Charlie Munger.
Okay, so let's talk about that evolution I've heard about Buffett's early cigar butt approach to investing, which sounds, well, not very glamorous.
It wasn't. Think of it like finding a discarded cigar with one puff left. Not pretty, but hey, it's a free puff. That was Buffett's early focus, looking for these deeply undervalued, often mediocre businesses and just squeezing out whatever value was left.
Yeah, he learned this from his mentor, Benjamin Graham, right?
Yeah.
And it worked well for him, especially when he was managing smaller sums of money. But how did he transition from cigar butts to these, wonderful businesses we see in Berkshire's portfolio today?
Well, that's where Charlie Munger's influence comes in. Munger had this really fundamental insight. It's better to buy wonderful businesses at fair prices than fair businesses at wonderful prices.
It sounds so simple, but it's so profound. It's about recognizing that a truly exceptional business, even if it's not a screaming bargain, can generate exceptional returns over the long run.
Oh, exactly.
But was it hard for Buffett to make that shift?
It was. I mean, remember, he was doing pretty well with that cigar butt strategy. It took a lot of Munger's, logic and convincing to get him to really change his approach.
And once he did.
Well, it was game-changing.
Yeah.
Think about See's Candies. They acquired that in 1972 for what Buffett initially thought was too high a price, $25 million.
Yeah, he almost walked away because it was 3 times the company's net tangible assets. He wasn't used to paying that kind of premium.
Right. but he did the deal. And it's a perfect example of the power of Munger's philosophy. See's has earned $1.9 billion pre-tax to date, and it's only needed an additional $40 million in investments. So think about that. $1.9 billion in profit on a $25 million investment.
That's incredible. And it wasn't just the financial returns. It was a valuable lesson for Buffett. It really opened his eyes to the incredible power of brands and durable competitive advantages. That sometimes it's worth paying a fair price for an exceptional business because in the long run, those exceptional businesses generate exceptional returns.
Absolutely.
It's like the saying, you get what you pay for, except in this case, they got a lot more than what they paid for.
Yeah.
But there's another really interesting aspect to Berkshire's success, and that's their very unique conglomerate structure.
Yeah, the conglomerate, often misunderstood, a lot of times unfairly maligned.
Cool.
But in Berkshire's case, it's been a key driver of their success.
Okay, so let's unpack that. What makes their structure so different and so advantageous? Because let's be honest, conglomerates don't always have the best reputation.
No, you're right. And Buffett acknowledges that.
Mm-hmm.
He talks about, the sometimes shady history of conglomerates, how they were associated with accounting gimmicks and empire-building CEOs, and this focus on, deal volume over true business value.
So how has Berkshire avoided those pitfalls? What makes them different?
Well, for one thing, they've figured out how to turn this conglomerate structure into this incredibly powerful tool for long-term growth.
Mm-hmm.
And they've done this by really focusing on a few key advantages that this structure offers.
Like what?
Well, one of the big ones is their ability to allocate capital quickly and efficiently across all these different businesses. So, if one of their companies is generating more cash than it can effectively reinvest, they can instantly move those funds to another area with greater potential. And they can do all of this internally without incurring any taxes or, significant transaction costs.
It's like having an internal investment bank with the best interests of their businesses at heart.
Exactly. No need to go through Wall Street middlemen or pay these, hefty fees.
Right. But besides capital allocation, what are some other benefits of this structure?
Well, think about what happens when a family-owned business wants to sell. A lot of times their best option is to just keep running the business, right? Especially if they have family members who are happy to keep things going.
Right. That makes sense.
Yeah.
But what if they want to fully cash out? What are their options then?
Well, typically they have two main options. They can sell to a competitor.
Who's likely to come in, gut the place, fire loyal employees, and try to, squeeze every last drop of synergy out of the deal?
That's one possibility. Or they can sell to a private equity firm,
which will load the business up with debt, take out huge dividends, and then flip it to another buyer in a few years.
Right.
The business basically becomes a commodity, and the employees are left wondering, what the heck just happened?
Exactly. And that's where Berkshire really shines. They offer this third option, this, forever home for these businesses, where the company's culture and legacy will be protected.
Yeah, Buffett talks about this a lot in his letters. This idea that they intend to preserve the values and the leadership of the companies that they acquire.
Yeah.
It's not just about the assets. It's about the people and the culture that they built.
It is. Some sellers only care about the price. But a lot of business owners, they poured their heart and soul into these companies. They want to see their legacy continue. They want their employees to be taken care of. They want their values to be upheld.
So that's a huge competitive advantage for Berkshire. It allows them to attract these high-quality businesses that might not even consider selling to a competitor or a private equity firm.
Right.
But with all these successful businesses under one roof, why not spin some of them off?
Right.
I mean, it seems like a lot of people on Wall Street would be pushing for that.
Yeah, you're right. There are often calls for these conglomerates to break themselves up, but Buffett and Munger have a very clear answer to that. They say Berkshire's companies are worth more together than they would be as separate entities.
And their logic is really interesting.
It is. They argue that spin-offs would actually destroy value. First, you lose that incredible flexibility in capital allocation that we talked about earlier.
Mm-hmm.
Then there are the tax advantages that they enjoy as a conglomerate that they might not get as independent companies. And then, of course, there are the increased costs that would come from separating things like, shared services, legal audit, even the board of directors.
So, they've built a system that works, and they're not afraid to really push back against the conventional wisdom of Wall Street.
Yeah.
Are there any historical examples that kind of support their view? Has anyone tried this spin-off strategy and failed miserably?
Oh, there are. And Buffett actually points to this really striking example, the story of LTV and Jimmy Ling.
Okay, let's hear it. This sounds like a cautionary tale.
It is. So back in the late 1960s, Ling built this huge conglomerate through a series of these really flashy acquisitions and spin-offs. He was really promoting this idea of what he called, project redeployment. So his strategy was basically to buy a company, split it into pieces, and then spin those pieces off to the public, claiming that, this is going to unlock all this shareholder value.
Sounds kind of like what investment bankers are always pushing for.
Yeah, well, for a while, Ling was a Wall Street darling. He was on the cover of magazines. The press couldn't get enough of him. But as Buffett points out, he never really demonstrated any actual, managerial skills.
Okay.
He was a master of financial engineering, not of building successful businesses.
So what happened? Did this empire of spin-offs live up to the hype?
Well, as you might expect, it all came crashing down. His empire was built on, flimsy accounting, overvalued assets, and a lot of hype. By the early 1970s, it was melting down, and Ling himself was fired.
It's a good reminder that financial engineering can only take you so far. In the end, true value creation comes from building great businesses, not from manipulating numbers or playing Wall Street games.
Exactly. And Berkshire is a perfect example of that. They've built this incredible collection of businesses and a culture that really emphasizes long-term value creation over short-term profits.
Okay, so we've covered a lot of ground here. We talked about, strategic acquisitions, the magic of float, the wisdom of Charlie Munger's influence, the cautionary tale of Jimmy Ling, and the power of Berkshire's unique structure. But we're just getting started. In the next part of our deep dive, we're going to explore what the future holds for Berkshire Hathaway.
We'll uncover their strategies for continued growth, their approach to risk management, and their unwavering commitment to their shareholders.
Stay tuned for part 2. Welcome back to our deep dive into Berkshire Hathaway. Man, I'm still thinking about all the insights we got from that last part. This 2014 letter really is like a gold mine of wisdom.
Yeah, it is. Every time I go back and reread these letters, I always pick up something new. I mean, it's not just about the numbers, it's about the principles behind them.
Absolutely. It's like Buffett and Munger are giving us a masterclass in long-term thinking, disciplined investing, all that good stuff. But we've spent a lot of time looking back at their amazing track record over the past 50 years.
Yeah.
What about the next 50? I mean, what does the future hold for Berkshire Hathaway?
That is the question everyone wants to know, right? Especially when you consider just how massive Berkshire Hathaway is. How do you keep growing at that incredible rate when you're already starting from such a huge base?
I mean, it's got to be like trying to steer a cruise ship, right?
Yeah.
It takes a lot of force to change direction.
Exactly. And Buffett addresses that right in the letter. He's very realistic about the fact that, Berkshire's percentage gains in the future probably won't be as dramatic as what we saw in the past. The law of large numbers just makes that impossible.
Yeah, that makes sense. You can't double your money every few years when you're dealing with hundreds of billions of dollars.
Right. But he's still confident that Berkshire will continue to outperform the average American company. And they'll do this by sticking to those core principles we've been talking about. Growing their existing businesses, making those strategic bolt-on acquisitions, and always looking for new opportunities to deploy capital.
Okay, so continued growth is definitely part of the plan. But what about risk? Berkshire is known for having this fortress-like balance sheet and their conservative approach to investing. So how do they ensure that their shareholders' capital is protected, especially in a world that seems to be, increasingly volatile and unpredictable?
Well, that's a big theme throughout this letter. He's obsessed with financial strength and stability. I mean, he even says at one point, "We will always be prepared for the 1,000-year flood. In fact, if it occurs, we will be selling life jackets to the unprepared."
I love that quote. It's not just about riding out a typical economic downturn. It's about being ready for something truly catastrophic. He wants Berkshire to be the rock that everyone can cling to when everything else is going under.
Exactly. And he lays out these very specific ways in which Berkshire achieves that level of resilience. First, they have this large and reliable stream of earnings from all these diverse businesses. That means they're not overly dependent on any one particular industry or market.
Right, it's like don't put all your eggs in one basket.
Exactly. Second, they always keep tons of liquid assets on hand, cash and equivalents. This gives them incredible flexibility, and it means they're never forced to sell assets at a loss or scramble for financing when things get tough.
It's like having a giant emergency fund, but on a corporate scale.
Right. And third, they never expose themselves to these huge near-term cash requirements. So they avoid risky debt with short-term maturities. They stay away from those complex derivatives that can, blow up in your face.
So they're not gambling with their shareholders' money.
Yeah.
They're playing the long game, focusing on safety and stability. But I mean, this super conservative approach, doesn't that kind of contradict the idea of growth?
It is a bit of a balancing act. but they've figured out a way to make it work. They're not afraid to be patient and wait for the right opportunities, and they're very disciplined in their capital allocation,
Mhm.
only investing in businesses they truly understand and believe in.
And they've proven that this approach works. Even during times of crisis, remember the 2008-2009 financial meltdown? I mean, while other companies were struggling to stay afloat, Berkshire was able to step in and be a first responder. They had the capital to provide support to those who needed it.
Yeah, that's a great point. They were in such a strong position because they had avoided all those risky bets that brought down so many other companies. And I think that highlights a really crucial difference in their thinking. Buffett even points out that CEOs, especially those who are, getting close to retirement, might have a totally different idea of risk than Berkshire does. They might be okay taking on risks that, have a small chance of blowing up in a given year, figuring, hey, they'll be retired by the time the real consequences hit.
It's almost like they're playing with someone else's money at that point.
Yeah. Well, yeah, in a way they are. But Buffett and Munger, they take a much longer view. They're not willing to play Russian roulette with their shareholders' capital, even if the gun has 100 chambers and only one bullet.
That's a great analogy. It really shows how they see themselves as stewards of their shareholders' wealth. It's a responsibility they don't take lightly.
Not at all. And that brings us to another key point that Buffett keeps emphasizing, their commitment to being shareholder-minded.
Right. He says that Berkshire operates more like a partnership than a traditional corporation.
Exactly. And this whole partnership mentality is really reflected in how they handle dividends. He even includes this shareholder proposal from their 2014 annual meeting. It was asking the board to consider paying a meaningful annual dividend.
Yeah, I remember reading about that. The argument was that Berkshire had more cash than it needed, and that, the shareholders, unlike Buffett, weren't all multi-billionaires who could afford to wait for their investments to compound over decades. They wanted to see some of that cash flow back to them in the form of dividends.
Right. But the shareholders overwhelmingly rejected that proposal. 98% voted against it.
Wow. I mean, that's pretty remarkable, considering that dividend-paying stocks are usually pretty popular with investors, especially those who are, looking for a steady income stream.
It is. And I think it speaks to the unique nature of Berkshire's shareholder base. They're a group of long-term investors who trust Buffett and Munger to allocate capital wisely. And they believe that reinvesting those earnings will ultimately generate far greater returns than any dividend would.
So they're all in this together. They're aligned in their belief in Berkshire's long-term vision. But even with a shareholder base that's as aligned as this, how do they ensure that their unique culture survives after Buffett and Munger are gone? How do you prevent a company this size from becoming just another, faceless corporate bureaucracy?
Well, that is the million-dollar question, isn't it? But thankfully, Buffett addresses that head on. He knows that Berkshire's culture is one of their biggest advantages. And he's put several structures in place to try and protect it.
Yeah, really. Like what are some of the safeguards?
Well, it all starts with their board of directors. They operate very differently from most corporate boards.
Okay, tell me more. What makes their board so unique?
Well, for one thing, they're paid just token fees. They're rewarded mostly through their ownership of Berkshire shares. And those shares, by the way, were bought on the open market. They weren't, gifted through options or grants or anything like that.
So their interests are completely aligned with the other shareholders. They're not just collecting a paycheck. They're owners of the business, just like everyone else.
Exactly. They have skin in the game. And here's another interesting thing. Berkshire doesn't even have directors and officers liability insurance.
Wow, so they're personally liable if something goes wrong? That's a level of accountability you don't see very often.
Right. It shows a deep commitment to good governance and stewardship. They're not hiding behind insurance policies. They're putting their own reputations and fortunes on the line.
Man, that sends a powerful message, both internally and externally. But what about the day-to-day operations of the business? How do they prevent Berkshire from getting bogged down in all that bureaucracy and endless committees?
That's where their decentralized structure comes in. Berkshire operates with an amazing level of autonomy. Their subsidiaries, they basically run like independent businesses with a lot of freedom and flexibility.
Yeah, Buffett talks about how they don't even have a legal department, a human resources department, or even a strategy department at headquarters. And they don't require their subsidiaries to submit budgets, which is kind of mind-blowing when you think about it.
It is. They really trust their managers to run their businesses with a sense of ownership, just like they were doing before Berkshire came along.
Makes sense. Why try to micromanage a bunch of successful CEOs who are already experts in their fields?
Exactly. Their philosophy is to find talented managers and then get out of their way. Let them do what they do best.
But there's got to be some level of oversight, right? I mean, how do they make sure everyone's on the same page and rowing in the same direction?
They do have a small but very efficient team at headquarters. Buffett calls them his tap dancing to work everyday crew. And he really praises them in the letter. They handle those essential functions like capital allocation acquisitions and financial reporting, but they don't get involved in the day-to-day operations of the subsidiaries.
So it's like they've created this system that combines the spirit of a small business with the financial strength of a huge corporation. Pretty cool.
Yeah, it is. But even with all these safeguards in place, the question of who will eventually succeed Buffett, well, that remains unanswered.
And that's what we'll be exploring in the final part of our deep dive into Berkshire Hathaway.
Stay with us as we try to solve this succession puzzle.
All right, so welcome back to our deep dive into Berkshire Hathaway. And we've talked about a lot of really interesting things, their approach to business, investing, their unique structure, all that good stuff. But, there's this one big question that we keep coming back to, the question of succession.
Yeah, it's the big elephant in the room, right? I mean, Buffett was 84 when he wrote this letter. And even with, all his energy and his incredibly sharp mind, everyone's wondering who's going to lead Berkshire when he's no longer around.
Yeah, so does he give us any hints in this letter? Does he drop any names?
He doesn't come right out and name a successor, but he does offer a couple of clues. He mentions two standout managers, Ajit Jain and Greg Abel. Both of them have these incredible track records.
And these aren't just any managers, right? He seems to have a ton of respect for these guys.
Oh yeah, he does. He calls them proven performers and says they would probably be underdescribed as world-class. He even says world-leading would be more accurate. So, that's pretty high praise coming from Warren Buffett.
Yeah, it is.
Yeah.
So he's definitely signaling that these are guys who could potentially lead Berkshire into the future. Look, potential is only part of the equation, right?
Yeah.
But what else are you looking for in someone who's going to fill the shoes of Warren Buffett?
Right. Well, it's not just about finding someone with a great track record in investing. You also need someone who really embodies Berkshire's unique culture and values, someone who gets the importance of long-term thinking and disciplined capital allocation and decentralized decision-making, all those things that we've been talking about.
It's got to be someone who can carry the torch, not just fill the position.
Exactly. And Buffett emphasizes that both Jain and Abel, they have those qualities. He talks about their deep commitment to Berkshire's culture and his confidence that they would, maintain that decentralized structure and that shareholder-minded approach. That's been such a big part of his leadership.
So even without explicitly naming a successor, it sounds like Buffett's pretty confident that Berkshire's future is in good hands. He's not just building a business, he's building a legacy, creating this system and a culture that can thrive long after he's gone.
Yeah, and I think that's a really key takeaway from our deep dive here. Berkshire Hathaway is more than just a bunch of businesses. It's a testament to the power of thinking long-term and allocating capital wisely and fostering this culture of trust and accountability. It's a great reminder that building a successful business isn't just about making money. It's about creating something that can truly endure.
It's about building something that can stand the test of time, even as the world around us keeps changing.
Exactly. And, we may not all be Warren Buffett, but we can learn from his example and apply those principles to our own lives and investments.
Absolutely. And that's what I love about these deep dives. We're not just learning about a company, we're learning about these timeless principles that can help us navigate our own financial journeys.
I agree. Whether it's understanding intrinsic value or being more patient and disciplined with our investments or, focusing on building durable competitive advantages in our own businesses, there's a lot of wisdom to be found in Berkshire's story.
Absolutely. Well, I think this deep dive has really just scratched the surface of Berkshire Hathaway's fascinating history. I mean, there's so much more we could explore in Buffett's letters and in Munger's writings. But as we wrap up here, I want to leave you with something to think about. If you could choose just one principle from Berkshire's approach to business to investing, which one would you pick and why?
That's a good question. I think for me, it would have to be their dedication to long-term thinking. It's just so easy to get caught up in the day-to-day noise of the market, chasing those quick profits or reacting emotionally to every little up and down. But Berkshire's success really shows that real wealth, the financial kind and the intellectual kind, it's built over years and decades, not days or weeks.
It's a great point. It reminds me that patience and discipline and that long-term perspective, those are essential for success in pretty much every area of life.
Yeah.
Well, that brings us to the end of our deep dive into Berkshire Hathaway. Thanks for joining us. And we'll be back soon with another deep dive into one of your sources. Until then, keep learning, keep growing, and keep diving deep.